Ever wondered how the government pays for roads, schools, and hospitals? The answer, in one word, is taxes. But have you ever thought about how taxes are designed? It's not just about collecting money. It's a delicate balancing act, a huge puzzle with two giant competing pieces: efficiency and equity. Get it right, and society thrives. Get it wrong, and you can stifle an entire economy. Today, we're diving deep into the fascinating world of tax design, exploring the core principles that every government, from the US to Indonesia, grapples with. This isn't just theory. These concepts affect your wallet, your job, and the services you use every single day. Let's start with a quick overview. Governments need revenue to function, and taxes are their primary tool. Think of individual income tax, corporate tax, value-added tax or VAT, and specific taxes on things like property or fuel. While the exact names and rates differ from country to country, the fundamental challenges are universal. In Indonesia, for example, there's the pajak penghasilan, or individual income tax, which is progressive, meaning higher earners pay a higher percentage. The rates range from 5% all the way up to 35%. Then there's the corporate income tax, currently at 22%, and the pajak pertambahan nilai, or VAT, which is a standard 10% on most goods and services. You'll also find land and building taxes and excise taxes on specific products like tobacco and alcohol. This mix of different taxes is designed to raise revenue from various parts of the economy. But every single one of these taxes comes with a hidden cost. This brings us to our first big concept: efficiency and its enemy, the deadweight loss. In a perfect world, a tax would simply transfer money from you to the government with no other effects. But we don't live in a perfect world. Taxes change behavior. When the price of something goes up because of a tax, people tend to buy less of it, and producers tend to make less of it. This distortion creates what economists call a deadweight loss. It's the loss of economic activity that benefits neither the beer, the seller, nor the government. It's value that simply vanishes. Let's take a real-world example from Indonesia: the high excise tax on cigarettes. The government's goal is twofold: raise revenue for healthcare programs and discourage smoking, and it does raise a lot of money. But it also creates a significant deadweight loss. Think about it. Some smokers, faced with higher prices, will cut back. They pay the tax and the government gets revenue. But what about the people who quit smoking altogether because of the price? They lose the enjoyment, or what economists call consumer surplus, they used to get from smoking. At the same time, tobacco companies produce fewer cigarettes, losing out on potential profit or producer surplus. This lost surplus, from both consumers who quit and producers who cut back, is the deadweight loss. It's a loss to society that isn't captured as tax revenue. The size of this loss depends on elasticity, how sensitive people are to price changes. If smokers are very sensitive, a small tax increase could cause many to quit, leading to a large deadweight loss. And the costs don't stop there. Beyond deadweight loss, there's the administrative burden. Taxes are complicated. You have to keep records, fill out forms, and maybe even hire an accountant. That's time and money you could have spent on something else. For businesses, this is a major expense, and let's not forget the government side. They need to hire staff, build systems, and enforce the rules to make sure everyone pays their fair share. The more complex the tax code, the higher these administrative costs are for everyone involved. All of this is a drain on the economy's overall efficiency. To really understand how taxes affect our decisions, we need to distinguish between the key rates, the average tax rate, and the marginal tax rate. Your average tax rate is simple. It's your total tax paid divided by your total income. If you earned 100 million rupiah and paid 15 million in taxes, your average tax rate is 15%. But the marginal tax rate is what truly influences your behavior. The marginal rate is the tax you pay on your next dollar or your next rupiah of income. Let's say you're considering working overtime. Your decision isn't based on the 15% you've already paid. It's based on the tax rate you'll face on that extra income. Now, let's shift gears to the other side of the coin, equity. Efficiency is about making the economic pie as big as possible, but equity is about how we slice that pie. What is a fair way to tax people? There are two main schools of thought here. First is the benefits principle. This idea is simple and intuitive. People should pay taxes based on the benefits they receive from government services. This works perfectly for things like a toll road. You use the road, you pay the toll. The more you use it, the more you pay. It links payment directly to usage. But what about funding national defense or the justice system? Everyone benefits, but it's impossible to measure how much each person benefits. So, for many public goods, the benefits principle just doesn't work. That's where the second idea comes in, the ability to pay principle. This principle argues that taxes should be based on a person's financial capacity to shoulder the burden. It says that someone earning 1 billion rupiah a year can more easily afford to pay 300 million in taxes than someone earning 50 million can afford to pay 15 million. This is the philosophical foundation for progressive taxation, where tax rates increase as income increases. It's based on the idea of diminishing marginal utility of income. Basically, an extra dollar means a lot more to a low-income person than it does to a billionaire. A progressive system aims to make the sacrifice more equal, even if the dollar amounts are vastly different. But here is a crucial twist in the story of tax fairness. Who actually ends up paying the tax? This is the question of tax incidence. Just because a law says the employer pays a tax or the seller collects a tax doesn't mean they're the ones who truly bear the economic burden. The real burden of a tax depends entirely on the relative elasticities of supply and demand. The side of the market that is more inelastic, meaning less flexible and less able to change its behavior, is the one that gets stuck with the bill. Let's look at a payroll tax, like the one for Indonesia's social security system, BPJS. The law might say that the employer and the employee split the contribution 50-50. It looks fair on paper. But who really pays? It depends on the labor market. If there are lots of available workers and not many jobs, meaning labor supply is relatively inelastic because workers don't have many other options, then workers will bear most of the burden. Employers know they don't have to raise wages to keep their staff, so the employee's take-home pay effectively goes down by the full amount of the tax, even the part paid by the employer. On the other hand, if there is a labor shortage and companies are desperate for skilled workers, meaning labor demand is inelastic, employers will have to absorb the tax. They'll have to offer higher gross wages to attract and retain talent, effectively paying both their share and the employee's share of the tax to keep the net pay competitive. The law on the books is just the starting point. The market determines the true outcome. So here we are, at the heart of the great tax debate. We have efficiency on one side, telling us to keep taxes low and simple to minimize deadweight losses and administrative costs. And we have equity on the other, pushing for a system that distributes the burden based on the ability to pay, which often means higher, more progressive taxes. And these two goals are almost always in conflict. A highly progressive tax system might be seen as very fair from an equity standpoint. But those high marginal tax rates on top earners can discourage work, saving, and investment. This shrinks the overall economic pie, creating a large deadweight loss, a major blow to efficiency. Conversely, a simple, low, flat tax might be very efficient, but many would argue it's deeply unfair, placing a much heavier relative burden on the poor. There is no single perfect tax system. Every country, every society has to decide where on this spectrum it wants to be. It's a choice about values. How much efficiency are we willing to sacrifice for a bit more equity? How much inequality are we willing to tolerate for a more dynamic and efficient economy? This is the fundamental trade-off that policymakers, economists, and voters wrestle with every single day. Understanding this trade-off is the first step to having a meaningful conversation about the kind of society we want to build. Thanks for watching. If you found this breakdown of the tax system helpful, don't forget to like, subscribe, and hit the notification bell for more deep dives into the economic principles that shape our world. See you next time.